Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. The Canadian economy added more jobs than expected last month. Data from StatsCan showing the labor market added 8,200 jobs in December, beating expectations. The jobs gains were led by full-time employment, mostly in the healthcare and social assistance sectors. Meanwhile, the unemployment rate rose to 6.8%. Shares of Aritzia are up about 5.14% right now after posting a higher profit in its latest quarter, as well as revenue that topped Bay Street expectations. The Canadian clothing retailer saw revenue jump 43% compared to the year before, and also raised its full-year outlook. Same-store sales also saw an increase across all categories. Aritzia says the results were driven by higher U.S. sales, digital initiatives, and marketing. Shares of Tilray are getting a boost as well. They're up about 2.3% right now. Net revenue and profit in the most recent quarter beat estimates, with distribution sales 26% higher than last year. Tilray's cannabis business also saw an increase boosted by higher sales in its Canadian and international segments. It expects to see growth in its medical cannabis unit following U.S. President Trump's move to reclassify cannabis. And looking at the markets right now, back to the upside for the TSX into record territory as well. It's up 0.73% for the day, resuming that nice little winning streak it has to start the year. South of the border, nothing but green down there as well. S&P 500 up 0.39, almost 0.4%. Dow up by 0.22. And the NASDAQ is up by more than a half a point. The Canadian economy added more jobs for a fourth straight month, but the unemployment numbers also grew. For more on this, let's bring in BNN Bloomberg's Lindsay Biscaya. Lindsay, thanks for joining us. Break down the numbers. Why'd they go the way they went? Well,
I mean, a lot of economists are saying that this paints, an okay picture of Canada's economy. It seems as though Canada is going to continue to muddle through. But some, especially economists from BMO, saying this looks like Canada's just hanging in there. So in terms of the numbers, employment rises by 8,200 jobs. We saw that many gained in the month of December. That's the fourth consecutive gain that we saw. But at the same time, the jobless rate jumped to 6.8%. So in December, there were 72,900 people who were unemployed, and that is the most in 3 years. So you've got a give and a take here. When it comes to the unemployment rate, a lot of economists are saying this is not due to layoffs. It's due to participation levels going up. So more people are actually looking for jobs. Therefore, you have more people who end up without jobs. That's just kind of how it works. When it comes to gains, those jobs driven by an increase in full-time jobs as well as self-employment. We saw most of those in the healthcare and social assistance sector. 20,000 jobs, just over 20,000 jobs was added in that sector. Construction added more than 11,000 jobs. So it's been interesting to see where these numbers are coming from, primarily in Quebec. But a lot of economists saying this doesn't show that we're quite out of the weeds yet, and 2026 is still going to be interesting to see how everything kind of pans out.
Good to see an increase with construction, because I think they took a hit last time.
Yeah, they did actually. Yeah.
What about the bank rate? That's probably the main thing people are looking at. Where's it going? Pull out the crystal ball.
Yeah, I know. That's what happens, right? When these numbers come out, a lot of people are looking at, what does that mean? Maybe more rate cuts. So the Bank of Canada, of course, has said that they don't foresee any in the near future. They said they've done all they can for the economy. Lower employment usually means a positive environment for rate cuts. But we've been speaking with economists this morning, including Jimmy Jean, chief economist at Desjardins Group. And he was saying he feels as though, given the numbers that we're seeing in terms of employment versus unemployment for the rate of December, for the month of December in Canada, he doesn't foresee that happening. Here's more on what he had to say in terms of predictions.
It's true that, at face value, Canada could benefit from support But I think the approach has to come really from the government. Interest rates, they work to a certain extent, but we know that they have adverse consequences in terms of fueling real estate exuberance. We've seen that movie before, and certainly that's not the approach we're thinking right now is the right approach long term to support this economy. We need to see more investment. We need to see trade diversification, and really the Bank of Canada interest rates only play a secondary role in boosting that.
So muddled growth probably for the rest of the year, with many economists saying they just don't know which way Canada is going to go, but probably underperforming the U.S. Of course, U.S. job numbers came out today. But it was interesting, economists from BMO also saying today that there's a lot of uncertainty in the year ahead, and that free trade agreement negotiation, the renegotiation of CUSMA that's coming up, that will weigh heavily, of course, on jobs numbers later on this year, because with so much uncertainty, businesses who don't know what's going to happen with their business, increased tariffs, lower tariffs, they don't want to hire people at the moment because you don't know whether you're going to be able to afford to keep them. So that's obviously something to keep in mind as well. It's just a lot of uncertainty still.
All right. Lindsay, thank you for that. BNN Bloomberg's Lindsay Biscay. Up next, we're going to get more on the jobs landscape with Travis O'Rourke, president at Hayes. Talking about the Canadian economy added more than 8,000 jobs in December, beating economists' expectations. The country's unemployment rate is also up, and full-time jobs saw a rise while part-time ones saw a decline. Let's break the numbers down further with Travis O'Rourke. He is president of Hayes. Travis, thanks as always for joining us in studio, especially. Initial thoughts on the numbers?
Look, there's nothing too exciting in it. 8,800 jobs, whatever. But I think we had a correction. Last month, I talked to you guys about you can't really go from 6.9 to 6.5, adding 50,000 jobs. So to now add 10,000 and go from 6.5 to 6.7, something was up there. I don't trust last month's data. 6.7, where we sit today, I think that's correct.
That feels real.
I feel like this is good.
What would have, just out of curiosity, what might have led to such a skew or a question? What would make people question the data from?
You know what? It could have been corrections throughout the summer. It could have been, who knows, someone missed a decimal point somewhere. I have no idea.
Yeah.
But I do know that 6.9 to 6.5, adding 50K, did not make sense. This feels good.
Okay. And when you look at the numbers that feel good, what are some of the positives that you're seeing?
I like to see construction going in the right direction.
Went up, right?
I do like that, just marginally, but we still like that. I really like to see that we've added 50,000 full-time jobs and dropped 42 part-time, particularly in December. December is usually driven by a lot of that, holiday spending. You've got kids in high school or university looking to pick up a few shifts there. So to see 50,000 full-time jobs, we love that.
And where's that all coming from? Like, is that the change in immigration that we saw, the drop-off in immigration? What's opened up those jobs and creation?
The largest driver is healthcare, social services. I think a surprising data point for most people. I think we added 33,000 jobs for those who are age 55 plus. Wasn't expecting to see that, but healthcare, social services, there's usually some alignment there. But yeah.
With the healthcare and social services, any concern that a lot of that is probably government jobs?
I think public administration went up, healthcare and social services went up. Yes, it's not that GDP driving that we're looking for, but I'm okay with it. I still think 2026 is going to be a great year for candidates, for employers, for the economy as a whole. And starting with a beat of most economists, they thought we would lose jobs. We had 10,000. It's not many, but I feel good about it.
Okay, I want to talk about 2026, and I just want to ask about the 55 plus one. Any reasons why we saw such a spike like that?
It's a complete guess. It's just, again, tied to healthcare and social services, where they tend to have a higher percentage of employment.
Yep.
I do think it's a correction. So I think looking at 1 month of data is probably not correct.
Okay, so looking forward to 2026, what do you think we're going to see?
Hayes we do a survey every year. We've got over half of employers increasing headcount. When I look back at the last year, whether we've had an election, we had government closure, we had a change in government, we've had tariffs, we've had wars, we've had Buy American. We've hit so many headwinds in 2025. And I think last January we were at 6.8. This we're at 6.7. It's basically flat. That's incredible. I think we have shown to be a very resilient economy. The housing market isn't moving the way most people wanted, but people are still spending. And we have been driving the economy as consumers. Collectively, there's enough tailwind taking us to 2026, whether it's through infrastructure investment, whether it's through mining, whether it's through energy. There's a lot of excitement in C-suites around Canada, and I think people are gearing up right now. Obviously, what's going on in Venezuela is a little bit troublesome in Alberta for the moment, but I think that urgency that it will drive to get energy projects actually moving, I'm really, really excited about employment in 2026.
And what about CUSMA? What kind of a factor is that? Can you even, until we know, really, how do you factor it in?
I mean, just this personal...
And also the Supreme Court decision as well down in the States that we didn't get today.
Personal opinion, I think we have to assume CUSMA's maybe not gone, but it's going to look very, very different.
Yeah.
And part of why Canada needs to work really, really hard, whether it's pipelines west or east or finding new trading partners or doing better domestic trade within provinces, is we can no longer rely on the Americans. And I think that's exciting to a lot of corporations looking to diversify who our partners are. The way the economy looked over the last 10 years is going to look very different than the way it looks in the next 10 years. The diversification into defense spend and infrastructure and energy, I think, is exciting for Canada. So to get through 2025 relatively flat, amazing. And 2026, I'm really, really excited.
Does it feel like maybe it's giving companies some confidence that they had to retool through 2025 through all the pressure of tariffs and everything else that was going on, the uncertainty, and yet you say they've come out and now they're looking to hire? Does it give them more confidence going into it?
I do. I think there's so much going on right now where Canadian CEOs, for the first time, and as long as I can remember, everyone is pulling in the same direction, from government to public to private. Everybody is going forward. We're seeing capital investment come into areas that's not just real estate. I'm really, really proud to be Canadian, and I think 2026 is going to be a year that, from an economic standpoint, we can all be proud together.
And what possible headwinds might there be, do you think?
I mean, who knows what will happen with CUSMA?
Yeah, that's
did anyone predict that we were going to have what we had in Venezuela in the middle of the night? No. But for me, geopolitics can happen, and it will. It'll impact us in some way. But the domestic initiatives that Carney has put into place will protect us. And could it be worse in 2025? It would be difficult to think about what else could come.
Okay, and what kind of what surprise? Are there any things that might be a surprise or a potential surprise, a good surprise? Let's have some good news instead of everything that's coming.
Yeah, definitely. I think the entrepreneurial spirit in Canada is alive and well right now. You've got a lot of tech startups that are starting to get additional investment. I think immigration policies in the U.S. are certainly making it a lot easier for a lot of those tech workers to come to Canada. I think our government is doing a lot of work in immigration to let those who don't have a degree and who have more skilled trades experience, lived work experience, to come into the country. I think the housing market is in a place where there's so much money sitting on the sidelines. We've got buyers around the country waiting to jump into it. I think the rare earths drive that's happening internationally right now, Canada's about as well positioned as any other country. I think there's so many ways that we can get pops. We're not going to get all of them, but we take 2 or 3, and we're going to be in a great place as a country.
Okay, we'll wrap it up there. Travis, thanks as always for joining us, and Happy New Year.
You got it. Happy New Year.
Travis O'Rourke is president at Hayes. And in the U.S., hiring slowed in December as employers added an estimated 50,000 jobs. Let's find out how this latest print could weigh on the Fed's January decision on rates. For more, we were joined earlier by Gennady Goldberg, head of U.S. rate strategy at TD Securities.
You did get a below consensus payroll report. What really jumped out was the lower unemployment rate. Now, some of that is unwinding some of this noise in the wake of the government shutdown. Certainly, you had lots and lots of noise in the data. What we're really seeing is a somewhat softer labor market, still very consistent with low hire, low fire. I think the good summary statistics are the 3 and 6 month moving averages are somewhere between 30 and 40,000 for private sector employment, and that's really kind of the steady state effectively. What we're going to be watching in the next couple of months is whether that unemployment rate really continues to drift higher, or if 4.6% was the high we've seen for now.
And the Fed, obviously, the labour market, infamously a lagging indicator, or traditionally seen as that. What message do you think the Fed will take from the latest few months in employment?
I think they're still recovering from, a lack of data as well. To some extent, I think you're going to see a message of data dependence. They're still waiting and watching a lot of that economic data. They are going to be leaning a little bit less heavily on their worries about inflation. I think inflation now is a little bit more under control than it's been in the last kind of 6 to 12 months, or at least on an outlook perspective. Really what we're looking at is, what happens to the U.S. economy next? Is the U.S. economy moderating? Is the labor market moderating? All of those things are really things that the Fed is going to try to ascertain over the next couple of months. If that unemployment rate stays steady, they could potentially pause for longer. Our view is still that they actually deliver a rate cut in March. We don't think a rate cut in January is likely. The market's effectively priced it out fully. The market's only pricing in about 7 or 8 basis points of cuts at the March meeting. But every data point matters. Every data point really matters to the Fed, and we're going to have data-dependent activity for the foreseeable future.
RBC came out with an incredible report this week. We're trying to get them on, that said consumption by 10% of U.S. households was behind, or lately has been behind, 1/3 of all economic activity in the United States. The gap in income and wealth has become so great. I guess that's tough for the Fed, isn't it? Because you've got one group that are struggling, relative, a huge portion of the population not doing that well.
Yeah, and that's kind of the fears about this K-shaped economy, right? You've got folks on the upper end of the income spectrum actually doing relatively well, folks on the lower end of the income spectrum not doing that great, and that you've got that divergence. Now, there are expectations that the folks on the lower end of the spectrum will get supported by additional tax rebates because of the One Big Beautiful Bill Act. What really matters for the FOMC, though, is what's happening to the higher echelons. The democratizing factor in all of this is why they're so focused on the labor market, is the employment picture. If the employment picture really starts to soften, whether folks are at the higher end of the income spectrum or the lower end, that really starts to affect everyone. As long as the unemployment rate is relatively steady, they don't really necessarily have to move rates materially lower, but they're aware that at 3.75%, they're still tight on a relative basis, relative to neutral, closer to 3%. So they are going to be looking to take rates a bit lower.
I guess there's only so much you can do with monetary policy when it comes to income inequality. Apparently, in the second quarter of last year, consumers in the top 10% in America accounted for just under half of all U.S. household spending. And that was up from just over 1/3 in the early 90s. So it sounds like a very unbalanced economy.
I'd question those numbers a little bit. What we've seen is the top 20% accounting for about 40% of the spend. Certainly depends on how exactly you derive the calculations. Yeah. I've seen some more extreme estimates, but it does certainly seem as though income inequality is quite significant. What really matters, though, is really who's driving economic growth. And if you are seeing issues at the lower end of the income spectrum, is that something that the Fed should address, or is that more for policymakers? I would argue that's less for monetary policy, more for Congress.
Gennady Goldberg is head of U.S. rate strategy at TD Securities. Well, a massive deal is brewing in the global mining industry. Glencore has confirmed it is in talks with Rio Tinto on a potential merger that would form a company worth more than $200 billion. We'll discuss the implications after the break. The buzz surrounding the Canadian hockey drama Heated Rivalry is indeed heating up, a show described as shifting the conversation over inclusivity in sports, and it's become an international sensation. Heated Rivalry isn't just a hit with viewers, it's boosting Canada's entertainment economy and showing the world our creative industry can compete. CTV's Heather Wright has more on the show's success and cultural significance.
And welcome to the show, Heated Rivalry.
Hudson Williams sat down on The Tonight Show with Jimmy Fallon and cracked a Canada dry. his heated rivalry character's beverage of choice, and a reminder of where one of the biggest shows on the planet comes from.
Is it sinking in how big this show is?
No.
Showcasing the two most talked about prospects in the world.
Heated Rivalry, the breakout show about hockey rivals that develop an off-ice romance, debuted last fall, winning praise for its heartfelt depiction of LGBTQ2S+ relationships and sparking discussions about representation in both TV and sport.
To have this kind of a romance story portrayed inside the context of men's professional hockey at the highest level, I think will have an impact.
The show has exploded in popularity, the talk of group chats in Tinseltown.
You guys made amazing, original shows that everyone couldn't stop talking about until that gay hockey show from Canada came along.
And go ahead, Connor.
The show is an all-Canadian export, based on a book by a Canadian author, set in Canada, filmed in Canada, and produced by Crave, a subsidiary of Bell Media, which also owns CTV. Film critic Richard Krause says Heated Rivalry is an example that Canada can be more than just Hollywood North.
We're not just a production house for Hollywood productions to come here and shoot things. We can generate shows that can find a global audience.
Heated Rivalry has been picked up for a second season. That is the good news for fans. The bad news is that season 2 is not set to be released until next year. Heather Wright, CTV News, Toronto.
Well, Glencore has confirmed it is in talks with Rio Tinto on a potential merger. Let's get more from Ben Davis, analyst at RBC Capital Markets. Ben, thanks very much for joining us.
Pleasure to be here.
So they're saying they're talking. Do you think the talk is going to go anywhere? How serious does this appear?
Well, this is not the first time they've talked. So this is actually dates all the way back to, I think it was 2014 when they first lobbed in a chairman's letter to try and see if something could happen between the two of them. But back in certainly last year, it got a bit more serious, but they couldn't agree on valuations. But with a CEO departure, a copper price rallying incredibly hard, and also the Argentinian investment environment looking a lot better, certainly Glencore as a basket of various assets looks increasingly attractive to the likes of Rio Tinto and BHP.
And it sounds like they're looking at all kinds of possibilities, either a complete merger or bits and pieces.
Yeah, they haven't quite given us the shape of it quite yet, and also what the prices are. So they've got a month to let us know what that will be. But what for us, it would make most sense to do just a straightforward merger. We saw BHP last year try to attempt a merger with Anglo American, but stipulating various kind of pieces that had to happen with a spin-off of its platinum operations, its iron ore operations. Shareholders eventually pushed back on it and said, the premium that wasn't being offered given the complications. So I think Rio would prefer keep it simple, come up with a premium that is sufficient to get Glencore shareholders over the line, but at the same time, obviously not upset their own shareholder base that would be worried that they're buying assets at a premium after a very big rally in copper prices.
And also, I guess the other concern would I assume would be for shareholders, the coal. They've divested all their coal, and now they're looking at buying a company that's big on coal.
Yeah, it's the fashion of commodities comes and goes. With coal, there's you can discover nuance with coal. I mean, there's particularly over the last year, we've actually seen an incredible re-rating in the multiples in Australia and the US. It feels like we are moving past peak ESG. And also just from an energy security kind of perspective, coal is still a hugely important ingredient for the energy mix where everyone is short of energy. So there's a argument to be made that actually coal is better suited belonging in these bigger companies that will responsibly wind it down when the time is right and there's other energy options out there. So Rio's actually, there's been some media reports suggesting that, Rio is willing to keep coal, which it would have, I think, surprised quite a few people this morning.
And how would that sit with investors? Would they be okay with that? I mean, they were the ones that pressured them to get rid of it in the first place. Or is 8 years, I guess, or 8 years enough time for people to forget?
Rio got out at a good price on their coal assets. I think given at this point time around, the big concern with coal is, who you could sell those assets then to afterwards, and how much of are those assets stranded assets in terms of coal prices are going to collapse. Given where demand is heading, and continues to be incredibly robust, even in the thermal coal space, there really isn't any danger on that. So I think for most investors, unless there's obviously some have incredibly stringent ESG hurdles within their own funds that they can't own those stocks, and that does affect Glencore. But for a Glencore Rio Tinto merger, coal becomes a fairly small part of the pie, and it shouldn't be of any relevance really, certainly at these prices.
And I mean, there's still growing demand. They're building coal plants in China right now like crazy, if I'm not mistaken. Who would win on this between the two, or can they both win on this?
I think they both win on this. I think Glencore wants it more than Rio. I think Glencore's been looking for an exit for a number of years, and the time is definitely right for them. For Rio, it also makes a lot of sense. I mean, it is incredibly hard to get copper exposure in the size that Glencore is offering. Once Glencore is in theory gone, say if that does happen, there are very few names out there which are of size that could either be taken over or also that are freely available in the markets. It really is the quantity that everyone wants, but it's incredibly hard to get hold of.
And just, I'm not sure if you can talk to this or not, the impact on Canadian operations, do we know?
At this point, no. I mean, certainly Rio, the biggest exposures that Glencore has, they have coal, the Elk Valley Resources coal exposure, which is a phenomenal asset, and there's also other bits and bobs that they have up there. I don't think there's any danger that this merger would change the scope of that at all. Certainly they both been pushing to have increasing Canadian exposure at this time.
And then what would be next if this actually does proceed? And then what about, are we going to see more mergers? And is this going to be the start of a merging year?
Yeah, it does tend to happen like that. If someone's stealing the last sweets in the shop, you're going to grab whatever you can, and as I said, there's not many others, and the others are potentially more complicated. We would suggest, companies like First Quantum are interesting, but have, we need the clarity around the Panama situation, but that would be another potential target for those looking out to get increasing copper exposure.
And then just quickly, either company commenting at all or no?
As of yet, we have had nothing beyond the statements that they are in preliminary discussions, and they will have to update us before the 5th of February. So it's going to be an interesting month.
All right. Ben, thank you very much. Have yourself a great weekend.
Very good. Thank you.
Ben Davis is head of European mining research at RBC Capital Markets. Coming up, we'll get more on the Glencore Rio Tinto situation with James Atwood of Bloomberg News. Data from StatsCan shows the Canadian labor force added more jobs than expected last month. The economy increasing by 8,200 jobs in December. Economists were expecting a loss of about 2,500. The job gains were led by increases in Ontario and Quebec, mostly in the healthcare sector. The unemployment rate, meanwhile, rose to 6.8%. I spoke to an economist who says the latest data is not enough to sway expectations for the Bank of Canada.
We think it's still on hold. We think it's on hold for the remainder of the year, unless something very disruptive were to happen. Of course, we're going to be looking at the CUSMA revision talks very attentively. I think that is the major wild card right now. But otherwise, with the information at hand, I don't think there's a compelling case to do anything at the next meeting.
The U.S. Supreme Court did not rule on challenges to President Trump's global tariffs. The levies involved are Trump's so-called Liberation Day tariffs, which place levies on most imports along with duties imposed on Canada, Mexico, and China. A Supreme Court ruling had the possibility of leaving the government on the hook for tens of billions of dollars in refunds. The White House has signaled it is ready to pivot if the court overturns the tariffs. West Fraser Timber will take a write-down associated with its U.S. lumber operations. The Vancouver-based company says it will record an impairment of $409 million in its fourth quarter. West Fraser cites persistently challenging economic conditions that have changed specific product pricing trends as well as demand. Looking at the markets, another up day after sell-off yesterday. TSX well over 32,000, well into record territory. It's up 0.73% today. And south of the border, similar situation. Green, green, green everywhere you go. S&P 500 up by nearly a half. Dow Jones up by nearly 0.4%. And the NASDAQ up by more than 0.6%. All approaching, getting into near record territories. Well, a massive deal is brewing in the global mining industry. Glencore confirming it is in talks with Rio Tinto on a potential merger that would form a company worth more than $200 billion. Joining us now for more on this is James Atwood of Bloomberg News. James, thanks as always for joining us. What's the latest on this? What are we hearing from the companies?
Well, the companies late yesterday confirmed that they're in preliminary talks, early stage talks, and that could include anything up into a full merger or acquisition by Rio of Glencore. That could be a stock-based deal, and we know that those Rio has basically until February 5th, I think the date is, to announce something. So the next few weeks are going to be very interesting in terms of what comes out of these discussions and how that might ripple through the rest of the industry.
Is there any one particular route that they may take? I know they're talking about maybe bits and pieces or the whole thing. Is there one showing being a little more favored?
Well, it seems like people are thinking that the more likely scenario is an acquisition of the whole thing, that Rio will buy Glencore. And at the center of all that, it does seem that copper is the main sort of strategic rationale. Glencore is a major producer of copper. I think it's guiding about 1 million tons per year. Rio Tinto does about 700, a bit more. So that combination would make it one of the biggest, if not the biggest, copper producer in the world, depending on how the deal is structured and whether or not they have to sell any assets. And a big part of that is of course, Latin America, where I'm talking to you from. Glencore has a significant stake in a giant mine called Collahuasi, and also stakes in mines in Peru, and is looking at developing large projects in Argentina, where Rio is also present, mainly in the lithium industry.
And has there been any reaction down there where you are?
No, not yet. I mean, it was just revealed yesterday. Generally, the reactions come from the capital markets, and then the approval processes through countries such as China.
And so, where the one other thing that was in here that might be, I guess, an issue was the coal. That Rio Tinto said it was okay with Glencore still having those coal mines. It would buy those as well, but yet they divested themselves of that 8 years ago.
That's right. I mean, the reporting we have is that Rio Tinto would be open to buying Glencore with those coal assets included. I mean, among others, Glencore has a rather large thermal coal mine in Colombia among its coal assets. So, that doesn't mean necessarily that they'll hang on to those assets once the deal is done, if it gets done. Those assets could be sold. But that is a big question, whether or not Rio Tinto now sees that its sort of ESG rating wouldn't be too adversely affected by retaining coal assets.
Okay, we have to wrap it up there, but James, thanks very much for joining us.
Thank you.
James Atwood of Bloomberg News. Coming up after the break, a new report highlights what could possibly be driving the economy this year. That's next. Edward Jones Canada is projecting the potential for positive returns as the bull market enters its fourth year, driven primarily by what they called double-digit earnings growth and improving economic conditions. Let's get more on this from James McCann, senior economist at Edward Jones. James, thanks very much for joining us.
Thank you.
What's the overall reason for the optimism that we're looking for a fourth good year?
Well, I think it's a combination. First, when we think about the economic outlook, we do see scope for improvement. We think that some of the trade policy uncertainty that really dominated 2025 should start to ease, especially if we see progress towards renegotiation of the North American trade agreement. We also think that the drop in interest rates last year should help activity rates at home in Canada. And then we know that fiscal policy has moved in a more supportive direction. So from the macro standpoint, we think the environment is improving. And then, as you mentioned earlier, we think that's an environment that's supporting quite solid corporate profitability. When we look at the sectors across the TSX, there's wide scope for fairly decent, solid earnings growth, we think. And that should set the stage, we think, for relatively strong returns in Canada this year.
And just staying with that for a second, and where are you looking for the strongest growth? Is there any one particular area, one sector?
Yeah, there's a few that we like. We like materials, we like energy, and we like industrials too. So we think there's some scope for those sectors to outperform. Most of all, though, we think a very diversified approach to investing this year will pay off best, with some potential for a significant broadening in earnings, not just in Canada, but also we think across global equity markets too.
Does that mean the shine is off a little bit on tech, or is it's still there, but people are saying, you know what, maybe time to balance things out a little?
I think that's a good way of putting it. We still remain relatively upbeat on tech. We still think an allocation towards, let's say, large cap US equities makes a lot of sense. But we think the gap maybe between tech and the rest will start to narrow over the course of this year. So really, I think it's about taking advantage of that broadening in earnings growth, especially given that some of those other parts of the market aren't quite as expensive from a valuation perspective.
Okay, and just going back to CUSMA and the economy for a second, are companies? I feel like companies now have kind of factored in CUSMA going either one way or the other, and they're a bit prepared. They're prepared for either possibility that we may lose it entirely, or we may have a new deal.
Well, I think most are probably hoping, at least, that the deal does survive. It's so critical in underpinning wide swathes of North American trade. We know that supply chains over years and decades have become deeply integrated across this continent. So, I do think it would be a really bad scenario for Canada, for the US, and for Mexico if there were to be some walk away or abandonment of that agreement. So my sense is that when I look at market pricing, and hopefully I think as well when I look at corporate expectations, is that they're banking on this remaining in place. Of course, they'll need to plan for a downside scenario in case there is some greater political volatility. But we also think that despite the likelihood, I think, especially over the first half of the year, of grandstanding around this agreement, we think its economic importance will mean that it largely remains intact.
All right, we saw the unemployment numbers out today. It's always a factor for the Bank of Canada. Do you see any rate cuts this year? Where do you see them doing? Or they're going to hold steady again?
I don't see any rate cuts now. I think this unemployment report probably summed up quite well how the Bank of Canada is feeling. On the one hand, you can see some signs of resilience. So the economy is continuing to create jobs. I think that that's encouraging. I think the one thing that keeps the Bank of Canada on alert is that bump in the unemployment rate. It's not quite back at its peak, but obviously increased quite noticeably. So I think given that mixed signal from the data, the Bank of Canada will probably feel it's pretty comfortable with rates where they are. Certainly, there's not that sense that they need to move into emergency settings and cut further and really add stimulus to the economy. But equally, it's not the sense that the economy is rebounding very rapidly or there's a need to tighten policy too. So really talks to me of this sense that they'll be happy to stay where they are on interest rates, and we think they'll be unchanged this year.
And how does inflation tie in with all that?
I think part of that story is that inflation should probably slow over the course of this year. We've seen some of their preferred core measures of inflation perhaps lean a little bit uncomfortably high towards the top of that target range that they look for, closer to 3%. But I expect inflation to slow, especially those underlying measures, perhaps driven by that loosening in the labor market you saw last year. And I think that will feed into domestic price pressures, and we'll get close-ish to 2% inflation by the end of 2026.
All right. And just beyond North America, there were a lot of markets that outperformed the U.S. We did. But where else are you looking, and what do you like about them?
Well, again, this speaks to our message on diversification. I think there are a lot of international opportunities which do look relatively attractive. We know that growth seems to be picking up in parts of Europe, helped by a shift in fiscal policy. Similarly, in Japan, we're seeing some improvement in domestic fundamentals, both from the inflation and from the growth side. And we think that's positive, along other governance reform catalysts too. So we do quite like international developed market equities, particularly in that sort of small to mid-cap level. And then on the emerging market side as well, we know that they've had a tough few years, but this combination of perhaps less dollar pressure, lower US interest rates, and improving global growth, I think that probably sets up a relatively favorable environment for emerging markets as well. So, again, when we think about diversification, that's thinking about points across the cap structure, that's thinking about different sectors, but different geographies too. And we think there's a lot of value in investing overseas this year.
Okay, we'll leave it there. James, thanks as always for joining us.
Thank you.
James McCann is senior economist at Edward Jones. Coming up, we'll check in on the markets on Bay and Wall Street. The Argo Sasquatch, an amphibious made-in-Canada vehicle, is designed to operate in harsh environments. It can swim, climb, and cut through snow and ice, and could be the future when it comes to saving lives in disaster situations. CTV's Omar Sachedina has more in this report.
It may just look like a souped-up tractor, but this is a kind of Canadian hero, a 5,000-pound hero that can revolutionize rescue efforts in Ontario. And it's the new love of Rahul Singh's life.
These are beasts, like they're extreme all-terrain vehicles.
Singh is the founder of Global Medic, a disaster relief charity based in Toronto.
Good. So
he is a recently retired paramedic who founded the group back in 1998. Since then, Global Medic has helped 6 million people in 90 countries with the help of 7,000 volunteers across Canada. And for the ones based in Ontario, at least, this tractor is going to make their work easier.
So what's behind you? This one's called the Argo Sasquatch. This, to me, is the future. At Global Medic, we always want to innovate as part of our way of getting the right aid to the right people at the right time. That's the next-gen innovation for us.
The Sasquatch can swim, climb, and cut through snow and ice, invaluable features for a Canadian rescue machine.
We know with climate change, we get these significant weather events. So if people are trapped by snow and we got to get in and rescue them, sure, we can come in by snowmobile, right? We can pull drivers off the highway. But if grandma slips and breaks her hip, we can't pull her out on a snowmobile. Make sure you grab it and you're going to this side.
We go for a test drive with Rahul on a farm field about an hour north of Toronto.
Perfect. Awesome. You're in? All right.
Inside, a computer that controls key functions, like deflating tires for more traction on terrain that's especially challenging.
So now you want to go to trail. So you either push there or there.
So this will automatically adjust the tire pressure?
Yeah.
It's a feature we needed when we got into a tough spot.
There you go. And look at it. It's incredible.
Requiring a 180-degree turn.
It's almost like it's got legs, right? And it's just slowly going from one side to the other.
Don't you think you should be driving into that ditch?
Yeah.
The $250,000 dynamo is funded by the Ontario government, and you might be surprised to learn the Sasquatch is made right here in Canada.
This completed machine weighs just over 5,000 pounds.
The factory employs about 150 workers, but despite their product's capabilities, because of U.S. tariffs on raw materials, they've had to pass on higher costs to buyers and lay off about 5% of their workforce.
We've had a slight reduction in some of our labor. Everyone's happy to be here. We're making a good product. And so we know that it is serving the greater good out there in the marketplace, but still apprehension is on everyone's mind on what the future holds.
The company says they have something to look forward to. The head of sales says the rest of the world is noticing them.
Where have you been able to branch out and sort of make some inroads?
Europe, Australia, New Zealand, countries around the world, we're definitely seeing business pick up.
We've got one and I want more.
But if Rahul Singh has a say, the Sasquatch is a homegrown machine that should pique interest right here in Canada.
Whether it's the storms, whether it's the snow, the ice storm, or the flooding, we know more people will be in harm's way. We're going to be responding a lot more and helping people, and we're going to need better tools right here in Ontario. So we should be using the Ontario-made solution for right here in Ontario.
Market Call is coming up next. Today on the show, we have Colin Chazinski. He is a Chief Market Strategist of CO Wealth Management, and we'll be taking your questions on relative strength and technical analysis. And let's take a look at how the markets on Bay Street and Wall Street are shaping up. You can see the TSX well into record territory. It's up 0.91% today. And what's fueling that right now is materials. Take a look at this. And it is up for the year. So the 6 trading days right now? Is that where we're at? Not even 6 full ones. It's up nearly 10%, 9.5% right now. Also pretty much doing as well is the... where is that? The materials index also up as well. So the energy index also up as well there. It's spun me around here. It's up nicely for the year as well. And one stock we just want to take a quick look at that's having a good day hitting near record highs is Aritzia. It is up 3% to 129 on the news of its earnings report. It had a absolutely great last quarter, and everybody is liking it right now. That's it for Morning Markets. We'll see you here tomorrow. We won't see you here tomorrow. If we do, we're lost. Okay, we'll see you on Monday. Have a great weekend.